So, Barry, you're saying, just so we understand this, that to get from 3% to 2% inflation target, which BOC Fed wants, or the Fed wants, that it's going to be difficult because oil has moved so much higher just over the past couple of months that it's going to be somewhat challenging. Where do you see oil going from these levels?
Well, if you look at the supply demand, supply suggests there's at least another $10 to $15 higher in oil. That assumes that demand holds up, and that is less certain to do that. But if the U.S. economy still kind of holds in and China doesn't collapse, then it's quite likely that we get another $10 to $15 higher in oil, which is then
Mm.
going to feed into core headline and core inflation, which is going to make it tougher for the Fed to cut. But what I would say is the Fed doesn't have a mandate on the price of oil. They do have a mandate on the unemployment rate. So even if oil goes higher, well, at the same time, the US unemployment rate is rising, and that the Fed will pay more attention to the employment markets than they will to oil. And I think that they will be more sensitive to employment than they will be inflation next year. It's an election year,
Mm.
and they
Right.
they made a lot of progress. They don't want to screw it up. I mean, they really were in a tough spot credibility wise when they were in the transitory phase. They've
Mm-hmm.
recaptured credibility. They don't want to lose it. So my best guess is the Fed does cut next year, but they will be too late in cutting, and growth will slow more rapidly than they were thinking, and the unemployment rate will rise. We just don't really know when. It doesn't appear
Hmm.
that it's this year, it's sometime in next year, and making a call whether it's first half or second half is really, really difficult too.
Yeah. Well, it's really difficult as well because, as you say, well, when you take a look at just the interest rates and the present value of money and the valuations of assets, it's difficult to know if you want to buy in when we see a dip in the market, and if it's just kind of a trading environment. It just feels like we're in a little bit of a trading environment, other than maybe to take some profits in the highest valued areas of one's portfolio. It seems as though it's a bit of a wait and see. But at the same time, Barry, it also seems as though what we've been seeing is somewhat of a Goldilocks scenario. We haven't had as many gyrations in the market lately. It seems as though it's somewhat stable. And that really isn't what people were expecting either, but it is what we're seeing right now.
No, but I think this downward move that we've had in the last week or so is going to be a bigger test. Technically,
Mm.
the market is breaking down more than it has and things. So we're going to see whether people buy this dip or not.
Right. Agreed. It has weakened as of late, that is for sure. But do you think it's going to be a hard landing or just a little bit of a recession?
Yeah, that's a really hard call. I think I, I think it's kind of 50-50 between those two things. And
Mm-hmm.
if it is a hard landing, the hard landing will come later than earlier, is the way I would
Okay.
frame it.
So, what does that mean for you? And we just have a few minutes here, and then we'll pick it up on the other side of the break. But what does that mean for you in terms of positioning and risk?
Well, right now, it's a no brainer. I think you just buy 2 to 3 year corporate bonds that, investment grade at 6% and high yield, good quality high yield bonds at 7.5 or 8%. And, who can argue with just clipping a 68% coupon while we're waiting to figure out how the economy is going to play out? But
Yeah.
at some point, you're going to need longer duration. And
Let's
the need,
wait. Let's leave it there. We'll pick it up at the other side of the break.